Having studied permanent establishment, let's have a quick discussion on certain deemed remittance rules. Now, if you remember, if at all there is an entity which has earned income overseas, then that income will be charged in Singapore only when the income is remitted to Singapore. Now, what tantamounts to remittance? Is it necessary for the funds to physically move to the geographical frontiers of Singapore, or are there other ways in which we could say that the income has been remitted to the country? Under Singapore's modified territorial basis of taxation, foreign sourced income is subject to tax in Singapore only when income is remitted or deemed remitted in Singapore, unless such income is exempt from tax under the Singapore Tax Act. Apart from the direct remittance of income, there are two situations where foreign income can be deemed remitted into Singapore and therefore subject to tax at that time. Now, the word deemed is very interesting. Okay, deemed is basically a situation where that thing you are talking about has not actually happened, but you are assuming that it has happened for you. You know, in India, you have so many universities which call themselves deemed university. Now, there is a real university, like a Mumbai University, Delhi University, so on. But there are, these smaller colleges which are now treated like a university. Are they a university in the typical sense of the term? No. But now you are treating them as if they were a university. Okay, there are two situations where foreign income can be deemed remitted into Singapore and therefore subject to tax at the time of remittance. The first is when foreign income is applied in or towards the satisfaction of any debt in respect of a trade or business carried on in Singapore. Okay. The second is when the foreign income is applied to purchase any movable property that is brought into Singapore. These rules were introduced in 1995 as a declaratory provision implying that this has been the tax treatment since the act was enacted back in 1948. Look at the second situation. You purchase a property in another country. Say you purchase a property in USA, and the second is when foreign income is applied to purchase any movable property that is brought into Singapore. So I was in USA. I purchased iPhones and MacBooks and iPads there, and I brought them into Singapore. So foreign income is applied to purchase any movable property that is brought into Singapore. So income that I had in USA used to purchase a property in USA, and then that property is brought into Singapore. You will say that there has been a remittance of income from that country into Singapore. Now, how many times does it happen that people tell their relatives or friends when they are coming from USA, ki, since the goods are available cheaper there, you bring those here. And then that is how you get iPhones and all of that at cheaper rates. Now there is a imagine, that I go to USA every year for 3 months and I earn good income there. And usually I don't bring that income here, because of these draconian tax laws. I let the money remain in a bank account in USA. And when I have to go to a trip to Europe or I have to do some other activity, I use that money. Now, what they are saying is income earned abroad is used to settle a trade debt incurred in the business in Singapore. So, foreign income. I had earned income in USA. I did not bring the money back into my bank account. When do you say that remittance has happened? When you are bringing the money from the other country, from your American bank account to your Singapore bank account. That is when we would say that normally money is remitted into USA. Money is remitted back to Singapore. Now, I want to be extra smart. I don't want to play with, I want to save my tax position. So, what I do is, I don't bring the money from my USA account to my Singapore account, but I had to make payment to a vendor. So, I directly transfer the money from my USA bank account to a vendor in Singapore. So the money never hits my bank account, it goes to a vendor. So the money comes to Singapore, but not in my bank account, which is why foreign income applied towards satisfaction of any debt incurred in Singapore is treated as remitted to Singapore. You understood the situation, how the Singapore Tax Act is trying to catch people who are trying to be extra sly. Or what I could do is I go to USA, I earn income there. I conduct classes, lectures, and all of that. I earn income, and I keep some of the money in my USA account, and I purchase, say, one iPad, one MacBook, one iPhone, one something. I purchase all these expensive things, and I bring those movable assets back into Singapore. So, income earned abroad, getting used to buy assets and bringing them into the country, that is basically covered under the rules of movable property, and that would also be considered as remittance to Singapore. So you see, they have a solution for every sly person out there who is basically trying to be over smart and outwit the government. To allay concerns on the part of various bodies that may misinterpret the intention of the amendment, IRAS laid down in the same year the following administrative measures and concessions that it would adopt when applying these provisions. So they have given some clarifications so as to avoid any confusions. Let's see what those are. The provision applies only to tax foreign income received in Singapore if the income belongs to an individual who is resident in Singapore or an entity that is managed and controlled in Singapore. So basically, what they are trying to do is they want to ensure that if you are a resident in Singapore, your global income gets taxed at least when you bring it back to your country. They want to leave no stone unturned, or they don't want to leave any avenue untouched when it comes to taxing your income. Foreign income that is applied towards additional investments outside Singapore will not be treated as having been received in Singapore under the provision at the point of reinvestment. Income applied towards additional investments outside Singapore. I earned dollars in USA and then I use that money to buy some shares or bonds in USA. That is not considered as remitted to the country of Singapore, where taxpayers with funds outside Singapore derived from both foreign income and other non-income sources outside Singapore wish to remit to Singapore the non-income funds only. Such claim is acceptable to the IRAS provided the taxpayers can furnish satisfactory evidence in support of their claim. This can be done by providing an account of the funds from both income and non-income sources on the date before repatriation and demonstrating that after the repatriation, the funds remaining outside Singapore are no less than the amount from income sources that has yet to be repatriated. Basically, they are talking about two things: income sources and non-income sources. Income is the money that I earn by carrying out a trade, by being in employment, by way of income, by way of interest, dividend, and all of that. But if the amount constitutes non-income sources, for example, say you had purchased a ticket, or you had some coupons which allowed you to go to a DMart, or like Costco is what they have there. It allows you to go to a Costco and you can show that, and you can get some items at a discounted price. You also have an option to get it encashed. Now, you had done one thing. What you had done was, you had $10,000. You loaded $500 onto a prepaid card, okay, which you can swipe at different locations, like you have it in malls in India, or in different festivals and events. They give you a card, they load money onto the card, and then you can go to various stalls and you can use the card there to buy food or whatever. Now, I loaded $500 on a card, and I spent around $200, and then the remaining $300 were not used. So I got the money back, and that money I sent back to Singapore. That is non-income sources. It was my money that I had loaded onto a card, then that money I got back and I sent it back to Singapore after the use was done. That does not count as income here. Here means Singapore, not India. And the provision applies to all transactions and assessments in respect of foreign income derived from the after the bill was introduced in Parliament. So basically, incomes derived after 7th of August 1995, which is the date of introduction of the law, all of them are taxed.